and welcome to BloombergQuint. We've had a shock announcement, and I'm using that word deliberately, from the Indian Central Bank. The Monetary Policy Committee met in an unscheduled session and have decided to raise the repo rate by 40 basis points. Simultaneously, Reserve Bank of India has hiked the cash reserve ratio by 50 basis points, all in response to building inflation pressures. Joining us to help us understand the developments, whether the RBI's reaction is justified or not, a panel of experts. Aditi Nayar of ICRA is joining us. Professor Ananth Narayan is joining us, as is Arvind Chari. Thank you all so much for taking the time to speak to us here and in a sort of unscheduled manner. Ananth, I am going to start with you. As someone who has watched monetary policy for very long, this kind of reaction, an unscheduled meeting, a combination of a rate hike, liquidity tightening, has to come in response to a situation which the central bank thinks is going to get uncomfortable. What's got them so worried just a month after they didn't do anything except change the stance?
Good afternoon, Ira, and absolutely. So first off, hands up, I have to admit, I had no inkling at all that this is going to come. I'm probably the last expert who should be talking about waxing eloquent on the MPC action today. But having said that, look, there were two surprises I think that the RBI and the MPC were looking at. First was, of course, the inflation print for March, which came at 695, probably higher than they expected. I sense that they also have a good sense of where the April inflation print is going to come out. And I suspect it's going to be closer to 8% than the 7% that people are expecting. Now, RBI, by the way, from what little I know, has a very, very good way of monitoring what's happening on inflation. So as of the end of April and the beginning of May, they would have a very good sense of what that print is going to look like. So I sense that that's the immediate trigger, which pushes all of the inflation trajectories going forward into a different orbit altogether. So while RBI had been saying 5.7% for FY23, my own little spreadsheet now shows a good chance of overall inflation averaging above 7% at this current pace if things go the way they are, just going by the future prices in oil. I think that's the immediate trigger, the fact that inflation is going to get, in a sense, unhinged. I think those 3 quarters of about 6% is now pretty much a given as things stand, and it could extend to beyond as well. So I guess that was the immediate trigger for the action.
Actually, let me then go straight to Aditi. If this has come in anticipation of uglier inflation numbers, Aditi, what do you think is playing out in terms of the April print? Is that going to be far worse than what the market is anticipating? I think 725 or so I'd heard, but would it be higher than that to have prompted a reaction like this?
Thanks, Ira. Well, our number is tracking 740 right now for April, and I completely agree with Ananth. I think that's the main trigger for this surprise announcement today. As soon as we heard that an announcement was coming, this is what we were debating. Are we going to get a stance change, a repo hike, or a CRR hike? And we got 2 out of the 3. And the sense I have is that it is coming because the RBI is now clear that inflation has risen further beyond 7% in April. Now, going beyond that, I think there's a couple of things. One, I do think that there will be a base effect led softening in the May print, but it's still going to be above 6%. So that's something we need to watch out. I agree with Ananth, which I do on most things typically, that we are at least looking at 3 quarters of inflation being higher than 6%. However, the unknown is, at what point do the geopolitical tensions de-escalate? And at that point, how much do commodity prices come down? Some commodities may come down by as much as I would guess maybe 10 to 20%. And with that, from that point onward, the inflation trajectory is going to look very different. But it's not possible for us to model that part of the inflation trajectory right now. So it's better to act sooner rather than later, at least work on re-anchoring inflationary expectations. And therefore, I still feel that how much more of rate hikes are required is going to be a very dynamic question that the RBI will and the MPC will keep reassessing going ahead. So I'm glad they've advanced the start of the rate hikes. But I'm not sure this necessarily means that we will end up getting the higher end of what the market's expectation was in terms of rate hikes going ahead, because we just don't know how long the tension will last.
Okay, we'll come to that in a bit. Arvind, I don't think anybody in the market had anticipated this either. I think everyone was saying June is live and, rate hike is very much on the table. But I think going by the way bonds have reacted, last I saw almost 20 basis points up. Clearly, it's caught the market by surprise.
I think monetary policy, surprise as a monetary policy tool is back. And, at the times of YV Reddy, he used to use it quite often and it had the maximum impact. Apart from the inflation worry that Ananth and Aditi spoke, I'll add two more points. One is the RBI officials were just last week attended the IMF World Bank meeting. And there, India is still kind of outlier in terms of still not normalized or not even talking about normalizing the crisis level, COVID related, pandemic related, accommodation that we did. And the second would be timing to do it pre-Fed, and just Fed is supposed to act tonight and doing it pre-Fed. And I think that monetary policy is all about managing expectations and helping manage expectations. And a big part of that comes from credibility. If the market believe you're credible and your actions are such, then they will allow you to manage expectations the way the central bank wants it to. I think these two factors have also gone into they doing a intermeeting, second, third is a holiday, they're again meeting on fourth. I mean, there's a lot of, I think these two things also trying to do it before Fed, because if the Fed would have hiked, say, 75 basis points tonight, and then the RBI would have followed, people would have said that RBI is being forced. They don't want to do it, but they're just being forced. By doing what they did today, I think they are restating they are taking back the credibility, which kind of was lost in that February policy, right? I also wrote my note as needless.
Yeah.
Of course, lot has changed since that, but a lot of us felt that that policy was just way off in terms of where the markets were expecting. I think this is a very good step from that perspective to tell the market that when circumstances change, we change and we are ready to. We are not only mollycoddling the market, we're also willing to surprise and take the pain and pressure of that.
The credibility argument, though, you could reverse that and say that this is actually tells badly on their credibility, that for the last 4 or 5 months, they've had no clue where things are, which direction things are heading, and now they're playing catch up. But Ananth, more seriously on this question of being behind the curve, you interact with foreign investors a lot. Is that perception very much there? And could it, or is it already telling on the currency markets? Because that would be one fear, certainly, right?
Yeah, actually, I tend to agree with Arvind and Aditi before that as well. I think there was a certain sense of questions around the credibility of RBI in its inflation targeting mandate. RBI was seen as being more willing to push the pedal on growth and to fund the government and the fiscal deficit than actually worry about inflation. Now, a part of that credibility was restored in the last policy, the April policy, when they actually put inflation ahead of growth. But even then, there was a question mark as to whether they would actually bite the bullet and go ahead with rate hikes. So while the OIS markets were pricing in several rate hikes over the next 1 year, fools like me were still saying, let's wait and watch and see how many rate hikes they actually end up delivering. By actually delivering a 40 basis point rate hike in between meetings and hiking CRR by 50 basis points, both of which, we were talking about June being live for maybe 25, maybe 50. This is pre-meeting, leaving June still live, doing 40 basis points and 50 basis points of repo rate and CRR hike. This is very, very strong. This is as inflation targeting as you can get. Now, is RBI playing catch up? It doesn't really matter. The fact is they are addressing the credibility question. I think they've addressed that in a big, big way today in a very strong fashion. I agree with Arvind there. In fact, if you see the reaction both on the bond markets and on the FX markets, I think that's reiterated. Rupee is stronger today. I think that reflects this growing credibility. Bond markets have reacted violently, as you mentioned, Ira. So, earlier it was down by higher by 30 basis points. Now it's up by about 20 odd basis points. OIS markets are up by 50 to 60 basis points. This is clearly unexpected. Nobody expected this. To that extent, I think credibility will be restored. It's still a long grind ahead, though. And remember, one of the languages they've left behind is they're going from ultra accommodative to accommodative, which seems to suggest they want to go up to 5.15 on the repo rate. And about 2 lakh crores on liquidity, which was the pre-COVID kind of situation. They're still not talking about the end game of going well, or let's say 6% on the repo rate. By the way, markets are now pricing in closer to 7% on the repo rate as the terminal rate. So we have a long chasm to bridge there as well.
Wow. Aditi, so this gets followed up to your sense with another June hike. If inflation, as you talked about, continues to look ugly between now and then. And also there seems to be some inbuilt comfort on growth and growth indicators that has allowed them perhaps to do this.
So, on the growth side, even the March high frequency indicators have, I would say, a little bit surprised on the upside. There is no effect of the start of the Russia-Ukraine conflict that we're really seeing on the high frequency indicators in the month of March. So that's, I would say, positive. And for this quarter, I think it's going to be more of a shift towards services than goods. Inflation is going to be part of the problem, but really with behaviors normalizing, we expect the service sector to do far better than the goods sector at this point in time. Coming back to inflation, the sense I have is that we are going to get a significant step down between April and May. But how much above 6% do we remain in the tentative May print that the RBI would have for the next policy meeting? I think that is going to determine whether we get a back-to-back rate hike or not. At this point, I don't think I'm not certain in either direction whether we're necessarily going to get a follow-up, 35 basis point rate hike in June itself, or don't want to, be in a position where the SEC thinks that they can at least wait one more month to another intermeeting or go all the way to the August meeting.
Okay. Let me just talk a little bit about the stance and what it says about future policy. Arvind, how comfortable are you with this wording of stance? Remain accommodative with focus on withdrawal of accommodation, staying away from going to neutral. Perhaps that's an indication of the fact that real rates will remain negative. How does the market interpret that stance?
It is a bit convoluted. I think in the June policy, maybe they will because there's too much of shock, right? Last time they changed some of the accommodative stance. This time they've hiked CRR as well. I agree with Ananth in the sense that you'll have to think from market's perspective, to think from the perspective that we have to go pre-COVID. So what was the condition pre-COVID? We were at 5.15 on the repo rate and negative liquidity. But the reason there, I think, retaining the accommodative stance is that maybe they still want to keep liquidity in positive territory. So normalize the monetary policy rate and still keep liquidity in surplus. I think that's what they are trying to indicate by the fact that they're hiking, but they're still accommodative. I think they're accommodative from a liquidity. So maybe, of course, it won't remain at 5, 7, 8 trillion. It will come down, and they will use multiple sources from the FX side to suck out liquidity. And you should expect another 50 basis points of CRR hike. Maybe that's coming in June as well as a graded one. But you should expect repo rate very quickly to go to 5.15, which was what it was pre-pandemic. And then weigh your growth and inflation dynamic. Of course, your inflation is priority. Growth is maybe slightly better than what it was pre-pandemic. Maybe pre-pandemic real GDP growth was about 4.5. And now maybe we are in that, it's very difficult to tell, but about say in the 5.5% range. So they will weigh that balance. But we still aren't talking about repo rate at 7%. Maybe the terminal repo rate and we can talk a bit more on that. I know you'll have a question on that. It should be about 5.5-6%, given the fact that growth is still weaker as compared to any previous cycles that we've seen.
Ananth, weighing on the use of the CRR alongside the repo. I mean, logically makes sense, but I mean, the quantum of liquidity that they'll pull out, given the surplus, is still not that large. So you still remain very heavily surplus.
Yes, Ira, bankers hate CRR hikes.
I know.
You end up putting a lot of money with the RBI in an unremunerated sense. And it also has, you can argue about it, but a multiplier effect, right? So you actually, it kind of multiplies the pain in many, many ways. It's kind of a blunt instrument, and I guess it reflects the fact that they're struggling at this point in time to control the amount or bring down the amount of liquidity. So they have decided to use a blunt instrument to start with. And I agree with Arvind, possibly we have more CRR hikes coming up and you will see bankers howling a little bit. But overall, I do see this as the RBI announcing and the MPC announcing very clearly that they want to get to 5.15% repo rate as the first stop, and about 2 lakh crores of surplus liquidity as the first stop. And this was the situation in February of 2020, before the pandemic actually hit us. Remember, at that point of time, we were still accommodative. So that's I think the distinction they're making between accommodative and ultra accommodative. So the way they're justifying the language of the stance is we are moving from ultra accommodative, which was because of COVID, down to accommodative, which was pre-COVID, which is 5.15 and 2 lakh crores. One quick point I want to make on this in this whole situation is that look, on the growth part that you mentioned, Ira, it's not looking great, right? All of what we've seen, we've just barely got back to where we were in pre-COVID times in FY20 levels, right? And the nature of the growth, and you've seen this several times being repeated, is very, very uneven. The formal sector doing spectacularly well. Informal sector, hopefully we'll see some relief coming from the contact-based services coming back. It's still very, very uneven, and employment seems to be really badly hit. The latest data for April employment data is available from CMI, suggesting 1.5 crore jobs have been lost in services and manufacturing put together over the last 5 years. Not good numbers at all. So it is a tough time for a policymaker. There is no easy answers available when you have high inflation and uneven and unsatisfactory growth and low employment. Last quick point, because we are seeing repo rate hikes now, the other thing which is going to happen is borrowers are going to feel the pinch. A lot of the incremental borrowing which has happened in recent times is on variable basis.
100%.
So the repo rate, it's linked to MCLR, it's linked to other things. Even the 6.5%, 6.4% housing rates that have been seen are actually 1-year rates linked to an underlying floating rate. You're going to see that pinch being passed on to borrowers because the banks are going to take it on. So that's another angle to worry about in terms of growth, etc.
No, that's absolutely true. Aditi, come in on that, and let's move into the sort of terminal rate discussion a little bit. So if we say 100 basis points is this cycle, and there are people who are saying it would be higher than that, but even at that, what parts of the economy are going to be sensitive to this higher rate? Where were we seeing traction which could now slow because of this unavoidable sort of rate hike situation?
So I would say that the eventual terminal rate for the middle of next year, or for let's say calendar year 2023, I would put at 5.5%. I don't think it's going to go any higher than that. And I think that after we get a burst of rate hikes right now, there will be a sort of pause to reassess the impact on growth. I don't think it's going to just be sort of hammer and tongs going after inflation policy. That's my personal view. I just don't see that as a likely outcome from the MPC, what we know and understand about the MPC. So like I said earlier, I think the fact that they've advanced the start of the rate hike cycle, I think that is very good, because we know monetary policy works with that. Now, in terms of what will be the impact on growth, now we had reduced our GDP forecast for FY23 to 7.2% in March itself. And as of now, we are holding on to it. We think that seems to be an appropriate level, and that's what the MPC had also indicated in April. So one of the things that we've been writing about, we've been coming back to this again and again, is that when we look at how things are going to play out in terms of demand, particularly for manufactured goods, with inflation going where it's expected to, we think that capacity utilization is going to stay steady in Q4, dip in Q1, and then go back up very slowly to about 75% by the end of this calendar year. And therefore, private investment is definitely going to get back at it. So if we have government capex really filling in the gap right now, then we can support growth and prevent it from falling below 7.2%. Because certainly in an upward rate hike cycle, those investment decisions are going to be questioned a little bit more. And the private sector investment is going to be just that little bit more cautious now that we're clearly in a rate hike cycle already.
Arvind, same question to you. Terminal rate hike expectations, but also the time over which we go there, and help us understand how you think markets will react to it. And I just don't mean the 10-year, just different segments of the market, how they play out from here on.
From a market perspective, the faster they move to pre-pandemic. So even if you get another 60 basis points hike and you get to 5.5, that's actually a better outcome, combined with the statement that we are no longer in a crisis, inflation is a bigger problem, and we need to remove the ultra accommodation, and we are back to pre-policy, pre-pandemic levels. The faster they communicate, I think the markets will then start pricing in, okay, we are no longer in a crisis, pandemic is over, we have an inflation problem, and let's price in where the repo rate and inflation and growth dynamics play out from that 5.5 or 5.5%, that level. if you look at the way the market's already priced, as Ananth said, maybe it's not priced for 7%, but it's priced for well above 6%. Quite a bit of the curve, the 2-year, 3-year, 4-year, 5-year government bonds. 5-year today actually traded above 7% after the rate hike. So that, that is pricing in a significant spread, even above Aditi's number of say 5.5%. So 150 basis points above that. Where in a situation where liquidity might remain in surplus, it's not going to go in deficit. The challenge for the RBI is what is our threshold potential growth? And I always come back to that question: is India's potential growth 5, 5.5, 6, 6.5? And that will determine how much can they go in this policy. And I think that's very fuzzy, both from a developed world perspective and from domestic, because of this constant supply side shocks that you're getting. You're coming out of one supply side, and then you got increase in inflation, and then you got the Russia-Ukraine problem, and now you have China. You're still not coming away from a supply side issue, which is impacting near-term growth prospects. Like if I have to wear the hat of the Fed, pre-Russia, they were already reacting to inflation, and they realized that the growth is much stronger, unemployment is much lower, labor markets are very tight, and they need to act. And they would have acted till about say Fed funds to 2.5%, and that was getting priced in the market. But with this supply shock of spurious uncorrelated inflation that is coming about, that's kind of it is complicating how much and how long can the central bank react in terms of rates. We would still believe that at 6% repo rate, that given the growth momentum that we're seeing and given the underlying growth dynamics, I think we apart from supply side pressures, we should be able to manage inflation if the repo rate goes from the current 440 towards 6%. It should happen over the next 1 year, right? I think that if there is no more supply shocks, then given that demand is so much more weaker than any previous cycle of rate hikes, I think we should be able to manage inflation. But it's a very data dependent thing, a lot of moving parts on supply side and inflation, very difficult. But markets are priced higher than already for that kind of increase. So the positive surprise of the markets will be that if commodity prices correct in the next 3 to 6 months, you will see a significant backdown of front end rates, to the 2-year to 4-5 year segment, which is actually priced in quite significant tightening in policy.
Okay, Ananth, last word to you. Where do you think rates could go, and where do you think they should go? But I'll throw in a slight political economy question for you as well, since you have a broader lens now. We spent the last 2 years worrying about growth and employment being problems, and they very much still are, as you said in your comments as well. But perhaps there was a political economy concern about inflation becoming more and more of an issue in the coming months as well. And that has not prompted the RBI, but allowed the RBI to act. I'm choosing my words as carefully as I can.
Yeah, you're going to put me in jail, Ira. So very quickly, look, on where the terminal rate is, I think I agree with the comments of Aditi and Arvind. Quick point I want to add is that so far, till February at least, the RBI was assuring us that they'll go on a very gentle glide path, that they will telegraph every move in advance, etc., etc. All that has gone out of the window, to be honest, right from the April policy onwards, because they warned us that that paradigm no longer works. And that's unfortunately going to be the way going forward. We simply don't know. It's going to be very data dependent. Remember that the market is pricing in the Fed rate at 3% by end of the year. We're pricing in 10 rate hikes between now and end of the year. And more, some people calling for 75 basis points, etc. So it's going to be a very, very dynamic situation. As of now, I think RBI has put the first milestone at 5.15% pre-COVID time and 2 lakh crores. But with inflation looking very, very uncertain, who knows? Second quick point I want to make is that unfortunately the only instrument available to the MPC is the repo rate, and to some extent to the RBI to liquidity, because liquidity has become a little more talked about as well. I would personally argue that repo rate does less for inflation than the longer end of the rate. There is a problem of negative savings rates and negative real rates available, but I think that's more linked to the longer end, which is right now even now suppressed than the short end. But that's a different discussion. On the political economy part, personally, I take a lot of confidence from the current dispensation in Delhi era. If you've got Ananth Nageshwar and the likes of TV Somanathan, they understand markets a lot. I would argue more than the predecessors did, right? To that extent, when you have the global markets reacting the way, and when you have the Fed undertaking rapid rate hikes, yes, it's a disjointed economy. Euro is doing something else, Japan is doing something else, China is doing something else, but the biggest economy is going clearly in one particular direction, and we are linked to that economy. It's impossible for us to stay, static. We are going to be impacted by that, and therefore, I think what understanding Ministry of Finance and RBI probably would have taken is that for credibility's sake, we simply have to react. I'm not sure it's for inflation control. I don't know if government believes that you can control inflation through repo rates, but purely from a credibility perspective, I think this has been blessed. The 10-year bond deal, by the way, is still the most well-behaved in the entire curve. Your OIS, 5-year OIS is up by about 50 basis points. Your 10-year bond is about 25 basis points higher, which is comparatively lower. I think the market still expects that between insurance buyers, pension fund buyers, and the RBI keeping a BDI on the longer end, that won't react as much as the short end will, right? So I think that's where the political economy really stands. On terminal rate, personally, I tend to agree with Aditi. I think 5.5 to 6 is where we should probably head towards, because growth is going to be a constraint as well. So hopefully inflation starts to get controlled. But as Arvind mentioned, the market is pricing in a lot right now, given the uncertainty. The OIS market, by the way, is closer to 7% right now in the terminal rate. All
right, I'll leave it at that. Thank you all so much for taking the time to join us at short notice. Really appreciate your analysis and insights. Thank you.
Thanks.
For